Okay, let's get started. This is Walter Zimmermann at United ICAP, and the title of today's special webcast is Bernanke's Bubble. And the subtitle is The Sky-High Stock Market and the Underwater Consumer. But before we get into the material here, I wanted to review the background for this webcast. And that background is that this whole pattern that we've been in since the internet bubble peak, this is a monthly S&P 500, the larger pattern suggests what's known as a broadening top. It's a classical chart pattern that you see during periods of extremely high volatility and extremely high uncertainty, where the market swings dramatically between rumors of one kind or another, and the broadening top would only need, in classical chart pattern terms, another new high above the 2007 high to complete itself. Now, there's an alternate interpretation of this, which leaves one with the same implication, and that is an expanding triangle. That it's still a peaking pattern, and here again, what would be required is one more higher high above the 2007 high, somewhere above the 2007 high, to complete a major top and set off a major decline. Now, much of chart pattern analysis, much of technical analysis is looking for pattern repetition. Where have we seen this before? Now, one might think, looking at this, these huge swings, that we've never seen anything like this before, but that would not be correct. We have seen this before, and where it occurred was back here between 1965 and 1975. You hear a lot about the lost decade. Well, it was a lost decade for stockbrokers and for investors alike, because it was a giant Cuisinart that just chopped everybody up and spit them out. You had new highs, sell-off, new highs, even more dramatic sell-off, dramatically new highs, and then a panic sell-off, during which the S&P 500 fell from 122 to 61. Now, what we think is going on is a larger scale version of that, and that there are new highs ahead above 1576, but then just as the new high here to 121 was followed by a disastrous flush of length, a major crisis, we would expect a similar outcome from the next set of new highs in the S&P 500. Now, this is technical, and there's two questions here. One is, well, how much of a higher high do we need? What is the upside here? Should I balance that against the downside risk? Well, our bearish case lately has been this 1590, 1593 area. If we connect the dots from the internet bubble peak to the housing bubble peak and the S&P 500, that resistance line cuts this month at 1593. And then if we go to the weekly chart and look at the move up from this low in 2011 as an ABC, the 618A equals C is 1590. And then if we start from this low, 1343, back late last year, 1343, and look at it as a five-wave move up, 1, 2, 3, 4. Ever since the repeat from 1531 held our key support at 1480, our 1 equals 5 target has been 1590. Starting to see a pattern here. 1590 on the monthly, connecting the dots from the internet bubble peak and the 2007 peak. 1590 on the weekly chart, counting up off from the lows of 2011. Now here we are, 1590 on the daily chart, counting up from the lows of late last year. And then finally, from this 1485 low, here, looking at a 5-wave move up, 1, 2, 3, 4. In our weekly report, we cited 1540 as the must hold for the bulls. It held there, is ricocheting higher once again, and here the 1 = 5 target is 1580. There's a whole bunch of stuff overhead, 1580, 1590. That suggests even if we're going higher than that, intermediate term, we're likely to suffer a serious pullback from that 1580, 1590. Now, as one last caveat, there are cases for something more significant than 1590. For instance, there's a case for 1665, but then a dramatic dump. And there's actually a case for something between 1780 and 1790, but then an even more dramatic dump. So we're in the territory where what all these models have in common, technically, is the presumption that the higher it goes, the harder it will fall. And what we want to get into here today is the background story. Is there a background story? Can we readily find major problems that would suggest that this rally from 2009 is a bubble, just like the rally from 2002 was a bubble, just like the rally from 1996, 1997 was a bubble? Can we find evidence that this is a bubble? The internet bubble was Greenspans, the housing bubble was Greenspans. Is this Bernanke's bubble unfolding here? So that's the backdrop. Now let's go into the material. And by the way, the slides from this, as well as the webcast we're recording right now, will be placed on the observations section of our website. So you'll be able to print out these slides, this text, and review it at your leisure later on. But again, the preface is technical analysis suggests this rally is a bubble and won't have a happy ending. So is there a background story to buttress or support, or at least indicate, that the technical view might be correct? And what we're going to be starting off looking at are some economic indicators which come in one of two varieties, either nominal, just the straight numbers, or real, adjusted for inflation. Nominal, the word nominal means existing in name only. So economic indicators not adjusted for inflation clearly don't have much value, otherwise they wouldn't be called nominal. And the numbers adjusted for inflation are called real. No accident there, the real numbers. And now whether we're just an investor trying to manage a few stocks, or we're an economist taxed with managing an economy, or we're an analyst, or we're a CEO, whatever of those categories we might most resemble, all these levels of endeavor have one thing in common. None of these efforts have any use for nominal numbers. We want the real numbers. We want to unmask the effects of inflation and see what's really going on. The curious thing is, while we all instantly and effortlessly dismiss any economic indicator that's not adjusted for inflation as a waste of our time, with the stock market, we probably have never even seen a real stock market chart that is adjusted for inflation. And we'll be getting into, I think, without too much trouble, why that's the case. Why do we demand that every economic indicator be adjusted for inflation? And why is the stock market probably the one economic indicator that we've never made an attempt to adjust for inflation? And we think the reason is human nature. The real Dow, the real S&P charts, as we'll be seeing later on, look awful, whereas the nominal Dow, the nominal S&P, is a bullish extravaganza. So let's proceed here. And this, again, is really the other reason for doing this report, beyond is there a background to the stock market rally as being a bubble, is why in general is it important that we look at nominal numbers versus real numbers. If we're an investor and our investments are not keeping pace with the rising rate of inflation, then we're exposed to the rising cost of living. And however much our stock portfolio may be going up in value, if it's not keeping pace with inflation, then it's only the mirage of wealth and prosperity. It's only an illusion of a successful portfolio. And on the bigger side of the economy, if the economic indicators are improving, but they are not outpacing the rate of inflation, then what we're looking at is not a recovery, but simply inflation. And that's why it's so important to look at economic indicators adjusted for inflation, because otherwise we have no idea what we're looking at. Am I looking at a recovery here, or am I simply looking at inflation? Now, maybe if you're managing a stock portfolio, it doesn't make a difference. You still want to be long either way. But the difference has to do with how things end. Rallies in the stock market based solely on inflation with no underlying economic recovery tend to not have happy endings. And if we inadvertently mistake rising inflation for rising prosperity and turn that into a business strategy, well then the business is in trouble because it's based on a deep flaw that there is a recovery, it's not just inflation. And what's the risk? The risk is that the gap between nominal and real, history shows, can only get so wide before that bubble bursts and the stock market gets trashed. Now, we all know what the Fed's been doing to try and head off deflation. The Fed has been trying its utmost to reignite inflation. The Fed nightmare is falling prices, because when consumers figure out that prices are falling, they will wait to buy, and then you head straight into a deflationary depression. So QE2 came along. You start the pump of QE2, easy in theory. You flood the market with easy credit. People take on debt to increase spending. That drives prices higher. That reignites inflation. That makes people feel wealthier. Higher prices makes people feel wealthier, or so the theory of the wealth effect goes. And wealthier people go out and invest more and spend more and hire more, and so the economy recovers. Well, the economy has been subject to almost 5 years now of this pump priming, of this flooding the market with easy credit. It began in September of 2008. Here we are, just about April 2013. Before too long, we'll be looking at the 5th anniversary of quantitative easing. So now's probably as good a time as any to look at how close an economic recovery may be after well over 4 years of applying this theory to the markets. So let's start with industrial production, something that should definitely go up with an economic recovery. And this looks great, but this is nominal. This is only seasonally adjusted. This is not adjusted for inflation. The same data, industrial production, adjusted for inflation, looks like this. A far less exciting and inspiring picture. Industrial production nominal, industrial production real. So right away, we see a huge difference. Those that are looking at this number and saying, wow, this is the best of all possible worlds, we really dodged a bullet, thank God for Ben Bernanke. That's what you would conclude from this. It's a little different picture here. Now let's look at median household income, which many would argue is the foundation block of the American dream, that is, making more money. And here we're looking at the nominal growth in median household income in red against the real growth adjusted for inflation. And basically, there's been no real growth. If we go back to the peaking of the internet bubble, and that's where many of these perspectives will begin from, median household income has fallen 8% since 2000, while the nominal has increased 26%. That's a huge bid ask between the real and the nominal. And again, it underscores the importance of ignoring the nominal. The nominal is the first step in creating an indicator adjusted for inflation. And here what we're doing is we are dividing the income by the CPI. We're adjusting using the consumer price index. Now, that's a whole other issue. The consumer price index, the producer price index. Where do these things come from? They come from the government. And for some decades now, the government has been doing everything in its power to understate inflation. Ever since the government was saddled with cost of living increases, it's been in a long-term trend campaign, a long-term effort to understate inflation and thereby minimize the government's exposure to cost of living increases. And there's a whole bunch of stuff that the government does. Hedonics, substitution, there's quality of life adjustments, whose entire aim is to understate inflation. Now, where do we go for real inflation numbers if we can't go to the propaganda machine of the U.S. government? Well, just a quick suggestion here. There's been a fellow called John Williams who, as an accountant, noticed that the CPI and the GDP and the unemployment numbers weren't really adding up to non-government numbers. So he started digging a little deeper, and he has a subscription service here. And just to kind of highlight, while the government is saying inflation is 2%, he's saying, well, if you roll back to how the government used to calculate inflation before the goal became minimizing its effects to minimize the cost of living increase to the government, if you use how the government used to calculate inflation, inflation is running at 6%, not 2%. So I just wanted to get that issue out of the way. So median household income, let's move along. And here's another way of looking at real versus nominal, going back to 1967. Not adjusted for inflation, it looks like we should all be gazillionaires. Adjusted for inflation, well, there's been no increase in real household income for many decades now. And the reason for that is it's been Fed policy to create, for some time now, to create the illusion of wealth by constant pressure on weakening the purchasing power of the dollar. If everybody thinks things are rising in prices, food, clothing, shelter, stock market. Well, then we all must be doing great, because look what demand is doing to these things. This must be wealth. But what this is showing here is the purchasing power of the average American was remarkably stable for 150 years prior to the advent of the Federal Reserve. And since the Federal Reserve came on the scene in 1914, the US dollar has lost 98% of its purchasing power. Don't think this is a coincidence. Flat, stable, reliable, out of control. Here we look at the whole issue of, well, wait a minute, consumer credit has broken out to new highs. Isn't that bullish? Well, the total consumer credit is in red here, and if this is total consumer credit taking out student loans. So this goes to the point that I'm reminded of the elephant. It uses one set of teeth for show, that is, its tusks, but the teeth that it actually eats with are far less impressive. This is the tusk, this is the teeth. Tusk, teeth. Tusk, teeth. Retail sales is another big one here. This is retail sales from 2000 adjusted for the CPI, the government's version of inflation, after they've jumped through several hoops to minimize the impact of inflation. If we use that shadow stats, John Williams' version of inflation, which is how the government used to calculate it, this is retail sales. Tusk, teeth. There's a huge difference here between looking at the government's inflation-adjusted retail sales and how the government used to calculate inflation and calculating retail sales from that. So the consumer, I think, is very much aware of the difference between nominal and real, and that's why consumer sentiment has been in an uninterrupted downtrend since the internet bubble peak. Yes, there's been rebounds. Most recently, we've had a big rebound from the lows of actually 2009 to 2011. There was a double bottom in consumer sentiment, and then the rebound from 2011. But while everybody was celebrating this rebound, we were kind of pointing out that, hold on, put the cork back in the champagne. This is still a downtrend. This is still a series of lower highs. And until and unless we see consumer sentiment break above this resistance line and then retreat and find support, until we see evidence that resistance has become support, we think it's more prudent to say that consumer sentiment is in a downtrend than to say that it rebounded. Now, this is another variation of that CPI chart that we showed. This one here. This is the amount of dollars per ounce of gold. In other words, how many dollars does it take to buy an ounce of gold? And there's a reason it's gone from basically $250 to $1,700 since the internet bubble peak. And that despite Bernanke saying he's got a great track record on inflation, and despite the government saying inflation is only 2%, You can fool some of the people some of the time, but not all of them all of the time, and somebody is on to what the government is doing here. Otherwise, you wouldn't see gold acting this way. Now, let's inverse this. We'll invert this, and we'll look at how much gold does $1 US buy. That has also been in a downtrend since the internet bubble peak. So if we look at gold as the true indicator of inflation instead of the government's manufactured numbers for inflation, one is tempted to draw a little bit different conclusion about how much of the recent improvement in economic numbers is just inflation and how much is a genuine recovery. And if we apply that to the stock market, this is in yellow, the Dow Jones Industrial Average priced in gold since the internet bubble peak. And in green, it's the Dow priced in US dollars since the internet bubble peak. And looking at it this way, one is tempted to make two conclusions. One, the US dollar doesn't buy what it used to, but also, has the stock market really been keeping pace with inflationary forces? To the extent that gold is a better indication of the inflation risk, the stock market has been in an uninterrupted downtrend since the internet bubble peak. Looked at in US dollars, what we see here, we think, is the fact that what is happening here is that more than the stock market going up in value, the dollar is going down in value. That is, it is taking more and more dollars to buy the same amount of stock. One of the main points we think this displays is that Bernanke is saying, well, there is no inflation, and we're saying, wait a minute, all the inflation is in the stock market. All that pump priming, all that easy credit going through the big money center banks, it's going into buying the stock market. It's going into buying commodities. The inflation here is in the value of a share of stock, not in the way the government calculates inflation to minimize its exposure to inflation. Now, we can look at this a little bit more precisely here. Here, we compare the nominal Dow Jones Industrial Average, monthly average close in black, to the Dow adjusted for inflation using the producer price index. Now again, the PPI is probably understating the inflation situation here, just as the CPI definitely understates it. But what one sees here is something pretty dramatic. A huge, unprecedented gap has opened up between the real Dow Jones Industrial Average and the nominal. Adjusted for inflation with this red line, what do we have? We have the peak in 2000, a lower high in 2007, and we're way below the 2007 highs even now. This chart was put together yesterday, so this is not outdated. This is as of yesterday. And what we also have is a low and a lower low. What's the definition of a downtrend? A series of lower highs and lower lows. That could not hardly be a different picture than the nominal Dow presents that has led to so much celebration and euphoria. The Dow making all-time highs. Okay, nominal, fine. Let's peel away how much of that new all-time high in the Dow is inflation and how much is a real economic recovery. When we peel away the inflation, yeah, there's been a rebound up off the lows of 2009, but we're nowhere near still the 2007 peak. Forget about the 2000 peak. So here we see the value of looking at the stock market as we look at every other economic indicator. Forget the nominal, look at the real, or at least compare the two. Don't just look at the nominal and say, okay, I'm done. You know, fill me up with length, because what's to stop this from just going on and on and on and on and on? Well, just to be aware that if that's your strategy, what you're buying into here is inflation, much more than a real economic recovery. And if you study the relationship between these two, you find that at a certain point of stretching the nominal above the real, the economy tends to run into problems. And you don't get a correction as much as you get a bursting of a speculative bubble. Now, who's to say how wide this will get from between nominal and real now, but it's already dwarfing what we had back at the 2007 peak. And there's no relief if we say, well, the Dow is a junky thing anyway. I can't believe you're even looking at the Dow. It's not even an index, it's an average. Who even bothers with the Dow anymore? Fine. Let's look at the S&P 500. It's an index of the 50 largest U.S. companies. Let's here compare nominal to real. Fine. I have no use sending this chart to the shredder. But this is the one that really matters. And if anything, it presents an even more impressive case for the recovery being mainly inflation and only nominally a real recovery. The 2000 peak, the 2007 peak, the recent peak. The gap between nominal and real in 2000 was burst by the breaking of the housing bubble. What will break this bubble? Now, there are other issues here that I want to touch on, and it looks like I'm going to be going for a few more minutes here. But the contrast between nominal and real is not the only affliction currently being suffered by the stock market. That is the other affliction here, is the extent to which corporate profits are dominating or corporate profits are replacing or subverting salary and wages. Here we look at corporate profits after tax in billions of dollars here in green, and salary and wages as percent of GDP. These are the salary and wages that drive the consumer economy. So, and this of course speaks to the whole issue of rising income inequality and rising inequality of opportunity. But this concentration of wealth, rising concentration of wealth in the corporations, is fine if you're long a basket of stocks in the S&P 500, but it's not so fine if you're tasked with reviving a consumer-driven economy. And this is, I think I'm almost done here, but yeah, I'm almost done. Here, we look at corporate profits as a percent of GDP against the S&P 500. And I would suggest that there's something fundamentally wrong with the economy when you get these kinds of gigantic swings. And at present, the concern is whether this recent rally to new all-time highs in corporate profits as a percent of GDP is a bubble, like this was a bubble into 2005, and like this was a bubble into 1998. And note how this was kind of a leading indicator. This turned down. The stock market ignored it for a while, but then finally couldn't ignore it anymore, and then sold off. They both roughly bottomed together. And then once again, corporate profits peaked well in advance of the stock market, but eventually the stock market couldn't ignore it any longer, and they both bottomed together. Now we're in a similar situation, and there's a great quote from one of the greatest investors of all time: profit margins are probably the most mean reverting series in finance. Oh, that's certainly the message of this chart, but saying they're mean reverting doesn't go nearly as far as one needs to go in stating the risk of a mean reversion from here. When you get these kinds of swings, a mean reversion is a catastrophe, is a crisis, because it's going to take so much to get back to the mean in terms of downside. So corporations are doing great right now, but even if we look at the most bullish chart out there, corporate profits as a percent of GDP, and we take the advice of some very wise people who have made a lot of money in the markets, even then there's cause for concern here. But the bigger concern is the squeeze that's being put on the consumer here, and the fact that our economy is not driven by the 30 Dow stocks or even by the 500 stocks of the S&P 500. Our economy, for better or for worse, is driven by the consumer, and the consumer is being squeezed here big time. And then some summary thoughts here, which will be in the slides I'll put on the website, as well as that's probably the best way to read them rather than going to the recording. So all of this was put together because the technical model says, just as occurred back here when the Dow fell from 122 to 61, the biggest hit yet is yet to come, and it will come from new highs. It'll come from a break above 1576. How much of a break? We don't know. 1590, 1665, 1780, 1790. We're tracking that day by day. We don't know yet. But the only precedent for the price action since the internet bubble says the biggest sell-off is yet to come, and it will come from new all-time highs. And hopefully we've established enough of a background story here to make this very bearish outlook seem less fanciful. That went along a little more than I had hoped, but before we sign off here, any questions, comments, observations on any of the points that I've made here today? Alrighty then, thank you for your time. Hopefully this is giving you some things to think about, and when if you want to review this or get a copy of the slides, the way to do that will be to go to our website. Let me just show you where that'll be. Just go to our WZ observations section, and it will be listed here. Remember that webcast that we did on natural gas? That's here. The webcast that we did on Spain, that's here somewhere. Yeah, problem of Spain. So as soon as I download it, give me about 15-20 minutes. This is where it will be if you want to review it or print out any of these slides. So thank you all, and good night. Thank you.